Hi, this is Randy Finney with Right Side of the Chart, and this is a early session update for Thursday, February 24th, 2022. Wanted to just do an update on the equity markets as well as gold and Treasury bonds. Those are kind of the risk-on, risk-off assets. So right now we're in what they call a risk-off mode, meaning stocks are under distribution, and as of lately, bonds have been and gold been rallying, and again that has almost everything to do with the technicals, but also fundamentals, as I would often talk about and have addressed lately. The charts will price in bullish or a bearish trend change, and then it's quite often going to align with some fundamental catalyst that gets things moving and gets that underway. Now, don't forget. Let's not forget the equity markets topped, especially QQQ, to me the most important index, because it's chalk heavy in the market leading FANG stocks. That topped back in November, and we were short at the time. First short op was there on that breakdown of this trend line. Second short opportunity or short entry posted was right there, and then on numerous pushbacks to this level right about here. That was really on the 60-minute chart right there at a different board here. There it is, that blue line, multiple shorting ups there. So that's where, for all intents and purposes, the entry was on this trade. So remember, Ukraine and Russia, that all kind of happened and really got started snowballing here. And so again, it was just kind of help move things along. But we're right at that point where I expected to see some, start to see some impulsive waterfall type selling, and that's what this is. You can see the drop off there in the last week or so. Nothing but red candles. That also, as I mentioned, will benefit those leveraged ETFs. I talked about using something like SQQQ, 3-time leverage short, or TZA for the small caps, my two preferred indexes right now. And we also have the shorts on the semis via SOXS, which is a 3-time leverage. And again, this is where, and I talk about it. I repeat myself quite often because there's not only new people coming into the site, but those members that might not trade actively that see what's going on, and they come in and start checking up on the updates. And this is what you want to see when you are in a leverage ETF, whether it's bullish or bearish. You want to see all that really matters is the close. And so far for the last 1, 2, 3, 4, 5, 6 days, nothing but green sticks. And that's where you'll actually not only lose on the decay that so many people talk about, it works in your advantage. In other words, you'll do better than 300% whatever the semis drop. And likewise in SQQQ, you can see here, this is where we're at that stage where we've seen the waterfall selling, and it's been nothing but green sticks lately. Even back here, we had a couple. So again, that's where you don't want to be in a leverage ETF, obviously against the trend, but even so, this is where you lose. This is where the decay happens, the back and forth in trading range. And so from point A to point B, even if you end up, the Qs end up, the NASDAQ 100 ends up exactly where it started, that's where you can actually lose money. And so again, this is where I'm comfortable being in them. Now let's talk about what's going on today. I did post in the under the homepage post that I made this morning with just reiterating those price targets on the small caps and NASDAQ 100. I posted that QQQ has made a near backfill of the gap, and again, close enough. If all eyes are looking at that gap backfill, you don't want to hold out for that. So I mentioned that as an objective short, and I believe it will be. We'll see what happens if the market powers on through there. It's not going to change anything right away. It'll be a little bit concerning to see them gobble up this whole gap and then take it out and close back above it. Because remember, we still, as of now, I'm going to flip boards here, we still have potential divergence. And this is my divergence line. That was just an uptrend line, which I said would help to see break and trigger some selling, which it did. But here's our divergence line, and I'm going to just move it. It's just like in football. You get a first down, they pick up the first down markers and they move them, and this is what you're doing, what I'm doing with the divergence line. Again, I've gone over this repeatedly lately, that I want to see these divergences taken out, because as long as they're still intact, These are quite often the catalyst for rallies to new highs. But we're in a bear trend. And, here was a case where we had positive divergence, and it certainly played out for a rally, but it didn't take us to new highs, especially the fact that it came right off the previous high. And so that, to me, right there was a check mark for the bears. It was a change of character in the market to see a nice 60-minute divergent low and not see it carry the market for anything more than just a quick counter trend bounce. And then, of course, that's where we're at. So we'll watch it. Now, we've had, remember, the market's a lot cheaper and a lot more oversold today than it was back then. And once again, I reiterated my targets today. I think we'll get there, but nothing's guaranteed, and you have to respect the technicals. It's what got us down here so far, and again, we'll see how the day closes and how the week closes. Today, if we turn back up, we'd have to rally quite a bit to get the divergence confirmed. What I mean by confirmed, well, again, I talk about this often. This is only potential divergence. The PPO is still pointing lower. We're in a downtrend. It's a momentum indicator, and it may continue lower and then take out the divergences. And if so, it'll just be another check mark for the longer-term bearish case, increasing the odds that my additional targets will be hit. However, should the market rally from here, whatever the reason, whether it's news out of Russia, something the Fed does, just general market forces as a whole, it doesn't matter. Technical analysis is all about, the reason the charts work. It is a clear history, a visual representation of where buyers and sellers have met and the battles that they've had before and where the levels of support lie. So we'll watch that. And as of now, a little snapback rally that I'm viewing as a shorting op. There's a gap again to be backfilled. We almost backfilled it today. Maybe we go for a full backfill. Maybe we go for more. And we just watch and wait. And if we close the day green today, then we'll watch this and see if this PPO continues to turn up and make a bullish crossover. That is when I consider it confirmed positive divergence. Right now it's only potential because we have at this point a higher low. But once we get the crossover, then that you effectively put in a higher low with a bullish crossover. And it doesn't guarantee anything, but it certainly increases odds. We don't have many. You can go back in time, and I've covered this before. You want to see those divergent lows. They're not common on the daily chart. And when you get them, especially in a bull market, it could lead to a very powerful reversal. So something I'll watch. And the takeaway is, depending on where you shorted, if your short entry was up here on any of the numerous bounce backs to say that 50% Fibonacci retracement, the 200-day moving averages, all these levels were mentioned, then there's no reason you should lose money. At very least, you lock in some profits. You give back a little profits. Again, if you're swinging down to the next targets, as I still am. And there's a downtrend line which could come into play. And so it'll be, if and as each of these levels start to get taken out. But as of now, I see no reason to cover shorts or to change my trading plan. And that's the other thing about it, guys. Remember, the key to doing this successfully is have a plan, stick to your plan, until and unless something changes significantly in the charts. If you're trading, if you're watching and get tied up in the moves in the 1-minute chart, the reversal today from where the market opened to the high so far, where that near gap backfill was about a 3.23% reversal. So if you're heavily short right now, on paper you watched a lot of this morning gains. You were really happy when the market gapped down, and then you were not so happy. If that's how you're trading and you're second guessing the position, this isn't for you. You're either trading with too much leverage or you're just not cut out for trading a correction in a bear market. I love those. I tend to flourish in those type of environments, and I've done it long enough to know that the one thing, and I talk about this all the time, it's this right here. When the stock market corrects, volatility spikes up. That can be measured by the VIX. The VIX is going up. We have VXX as a trade idea I laid out for you recently. On the first thrust down, when we hit my first target on the QQQ and IWM in the weekly charts, that's when we hit that second price target. And I gave you additional targets, and now we're thrusting up, and I think we'll go ahead and go on and now hit the higher targets soon. But my point, the takeaway is, when the market corrects, this goes up. This is a measure of volatility, the VIX. And so that is what I'm trying to say is you have to expect 3 percent daily, even more, 3 to 5% daily swings from highs to lows, and it just tells you, it just affirms you're in correction mode. Now, unfortunately, one of those big 3 to 5% swings is going to come on the day the bottom is in. I don't think it's here yet, and just wanted to kind of reiterate that for you guys, and also just let you know you have to, kind of sit tight and trust your trading plan. And again, you don't. That doesn't mean hold on with iron fist to short positions, especially when the charts start to tell you, hey, maybe the correction's over, maybe this is the start of something new, but I don't think we're there yet. That's what I just wanted to reiterate for you guys. In fact, like I said, this was a surprising gift to me, in my opinion. As short as I already was coming into today, I took advantage and added to that, and that's why I posted that in the comment section there. So, yeah, I didn't get posts like that. That's a 1-minute chart. I'm not going to fire it off and clog up your email with every little zig and zag the market does. So I always encourage you to come in when things are moving. Come in and check the comment section, and myself or others may put charts. Please, I welcome you guys. Share what you see. A lot of the trade ideas I get from you guys, I'm taking my eyes off something, whether it's Bitcoin or XYZ stock or anything else, and by all means post what you see, or throw out the questions to me, and I'll get to those as quick as I can. All right, so that's that. Let's see what happens, and from a again, a daily chart perspective, turn off all the lines, and that's what we have. We have now, as I expected, once we took out the recent lows, I expected, that waterfall type selling, and still do. And we'll be interested to see. I'll be very interested to see how today closes. So far, they're buying up the drop, and it'll. I try not to read too much in any one day's price action, especially if nothing technically significant changes on the charts. What I mean by that is, impulsive reversal so far. But day by day, if you want to do that play-by-play call, then it would be somewhat impressive to see them gobble this up, turn this into a big drop that we had into the morning lows, and close the markets green today, especially rally it strong into the close. I suspect as we reverse back, as we get up here, whether we backfill the gap or not, remember, this was big support. This was the bottom of my first target zone on the daily, which was also the sole target on the weekly chart, and that was because it was support. And support, once broken, this is TA 101, Technical Analysis 101, support, once broken, becomes resistance. So the ideal scenario, we don't always get what we want, would see what we're seeing now, them try to rally. They've got a way to go to get back up there, but to see a back test of that, or even a backfill the gap, and then the sellers step in hard, it would really help the odds to see us do what I think we might do, and that is, if today all this post-opening rally gets faded and then some, and we close back down solidly red today at or below this morning's lows, that's going to be a very big check mark for me, and I think the odds will shoot up substantially that we're going to hit my second target and hit it fast, as in the next, couple trading sessions, probably, by next week is my guess. Now, if they run it up here and close it green today, well, that shows you there's some stronger handed longs in the market and a little nervous shorts. I have no doubt that short interest has been spiking up lately, especially with all that's going on in Ukraine. That's when they don't want to short up here because they don't, we're on an uptrend and near all-time highs. That's when I like to short, and that's why I always talk about it. Gets less and less objective as you get closer to any targets, because you're more oversold, you get indicators oversold, you start to have divergences. But anywho, I don't want to ramble on. I just wanted to share my thoughts, and also share what kind of things I'll be looking for here, and share the fact that the gap backfill, or we're only right here on this weekly chart, we're right here at the bottom of the body of that candle. So, to rally up to make a back test there, that's 342, and that's another 4% from where we're at now. I don't think it's going to happen, but if it did, it would still not change anything technically. What changes things technically, at least on this weekly time frame, would be a solid weekly close back above here. That would certainly be and if it happens soon, a check mark for the bears. I'm sorry, for the bulls, because it would give you that confirmed divergence. So we'll see what happens, and that's why I do these constant updates. As of now, nothing's changed in the especially in any time frame that I'm looking at. All right, moving on. I wanted to update, well, we'll do IWM and give you charts today. That same story there. IWM actually is interesting because it ran at, remember, it was a little bit above, it came at those recent lows. That was it right there. This is the entire move down on IWM right there. And remember back a couple weeks ago, I gave you short entries that were beautiful on the SPY and QQQ. SPY hit the 61.8 Fibonacci retracement off its entire drop from the highs. At the same time, same exact time, QQQ hit the 50% fib, and right to the button you can see IWM hit the 38.2% fib, which is typically in all those. That's my, what I've observed over the years to be the most common retracement area, anywhere from the 38.2 to the 61.8 fib retracement. That's a typical counter trend bounce move, and that's all that was so far. Now, what do you have here? Well, IWM buyers bought the recent lows, and so far they have those lows. They also have potential divergence. So again, we all see what we want to see. Bulls see positive divergence there, and they see the potential divergence on the daily charts of QQQ that I showed you in SPY now, and so that's what they're looking at. And where I see just complete deterioration and a lot of check marks here out on the weekly and monthly time frames, everything that I've covered. And a big component too is put to call ratios have not spiked, nor has the VIX. They have not spiked to the levels that normally make me want to cover shorts and or go long. In other words, levels that have ended major corrections before. We're not there yet, and what that tells me is there's not enough fear in this market. As much as you think there is, and people might talk this talk and that talk about being bearish or what's going on with Russia and Ukraine, the most accurate sentiment indicator I have are the put to call ratios, and that's simply because there are bull bear polls where people, AAII is one of them, American Individual Association, I forget the whole acronym, AAII, American Association Individual Investors, I believe it is, and they do the weekly sentiment polls where they, pretty much come out and tell you if their members are bullish or bearish, and that's probably the most commonly watched sentiment poll. But again, I always say this, that is in rhetoric or in talk. I can be bullish or bearish, or any of those people can. They may be bullish and plan to buy, or bearish and plan to sell or short the market, but guess what? They don't have to do it. They may change their mind from the time that they check the box whether they're bullish or bearish. And however, when I look at the put to call ratio, that is actual people putting their money where their mouth is. So when the put to call ratio is high, I know a lot of people are bearish because they've been buying puts, whether to hedge or outright short bets on the market. And when the put to call ratio is low, then I know that the majority of market participants are bullish at that time. All right, so those are things that factor into where I'm looking at here, and I guess that's it. Takeaway is there's some levels to watch. IWM still needs to take out the recent lows. QQQ has done so. SPY has now done so as well. The S&P 500. SPY's at support. I had it a line. We have a line here at, actually I might have already had that. Was that one already on there? Let me see. Created back on, yeah, created that, almost a year ago, back on May 4th of last year. And you can see the reactions right here. Reactions from above, and then almost a reaction there. And so it's minor support. I don't expect much of a reaction, but again, the only potential thorn in the side for the bearish case at this point in time is that potential positive divergence. Still pointed lower, and I can sit here all day long and tell you what's bearish and what's potentially bullish about this chart. Bearish is this trend right here. That 0.64 indicator is solidly bearish right now. The last time the PPO signal line, that 9 EMA crossed below, was when COVID hit, and it told you we were in a bear trend. The trend had changed, and throughout the entire bull run up until just after the recent highs in the S&P 500, that trend indicator that remained without zero exceptions, it remained bullish. And not only that, it comes in and back tests the line that's support. And as a bull, that's you can buy, use that trend indicator in conjunction with other things. But we're below it, and when we drop below it, we got rejected off it, and it's headed lower. And so again, check marks would be to see the PPO turn up, confirm the divergence, to start taking back support levels, and then to see that trend indicator cross, particularly the white line. That's the last of the two to cross. And at that point, if and when those things were to happen, that's where I'd be scaling out of shorts and maybe even looking to go long. But that's not the case right now. All right, so hopefully that's that. I like to kind of just really reiterate my thoughts at times like this, because I'm sure a lot of you out there, if you're in the market, or even just watching it, want to know, what's going on and what are the key things to keep an eye on. All right, that's the markets for you, and I gave you targets on NQ. We'll just look at that for your futures traders. NQ. We have the divergence, by the way, on the 60-minute chart here of NQ is gone, and that's nice to see. See this? This is what I talk about divergence being burned through. We had potential divergence there, building on the 60-minute chart. We could stretch it and say we still have RSI divergence right there, but this divergence line is now, especially on the PPO down there, taken out with that lower low. And let's look at the, let me just glance over and see what's going on this 2-hour candle chart. Yep, also taken out, not by much, but by a hair. We have a slightly lower low there on the PPO. Here's our divergence line. RSI divergence, just like the 60-minute chart, is still intact. And so again, I'd like to see, to increase the odds that we're going to hit those next target, I want to see this get taken out. I want to see another thrust down. And look, that's also pretty big resistance right there as well. So there's work to be done. And just to reiterate, I think this bounce right now, if you were looking to add and you were a little hesitant before, or even get in short, it's probably going to be, let's just say you were one of the people that wanting to and you didn't short yet. Again, coming down as much as we've fallen, it's not nearly as objective as it was before, but you could take a shot here and use relatively tight stops, because it's all about risk reward. So I laid out this morning, for example, gave you the daily chart of NQ, showed you the target. Disregard these come through on the 60-minute chart, all these divergent lows and highs. Just disregard those. The big thing is a primary trend line there that was broken. The big divergent high we did have on the daily broke down there. I mean, this was the clearest short setup I've seen in a while on the market. Big swing trade. Lots of opportunities short on bounce back. But here's where we're at. We have that target down there is 12,202. I'm going to grab where we're at now and just measure it out for you. Here's that candle today. Nice reversal so far, so we're up there. So you're talking about 10% downside to my next target. And let's see, that should align. Let me make sure it does. I believe it does with QQQ as well. Got to go to the weekly chart here and grab about where we're at. If I grab too close, the trend line goes away. So let me grab over here. There it is. And that is, that didn't work. I grabbed too high. There, close enough, right to about where we're trading. Oh, no, I'm sorry. We're trading right here at the bottom of that candle. I almost grabbed the top. That's what I was trying to do. And there it is. That's about 9%. So roughly the same. And the way you look at it is, okay, so if you're going for 9%, you can use a 3% stop loss, and that's a 3-to-1 risk-reward ratio. Now, of course, if you short it up here, you can have a much higher stop loss to stay in the game, because running a 3% stop loss in this type of high volatility environment, you just have a higher odds of being stopped out. But again, if you short here and the market does bottom, it did bottom today, let's say, and those divergences play out, well, you don't want to risk $3 to make $1. You don't want to risk, in my opinion, you don't want to risk $1 to make $1. I like those favorable odds, so that's that. All right, let's move on and talk about the other things, and we'll wrap up here. Gold pulled back today, has pulled back pretty hard, and I think that's a buying up. Remember, I had a long-term buy signal or a powerful buy signal I've been looking at for a while here, talking about this symmetrical triangle in gold. This is GLD, the ETF on a weekly time frame. We took that out and went on to take out the previous reaction high, popped this one, and we're right about there now, that previous reaction high. But again, this was a major breakout, and so that puts gold, it reaffirms what I've been saying for many, many months, even over a year now, that this correction was anticipated. We got out our gold positions and our miners there when we hit that high, figuring that that would be give us a pretty healthy correction, and it did. And so I maintained all along that we were in a bull market consolidation in this triangle, and we just broke out. So if I'm right, so far it looks good, then this is a major buy signal, and that means gold is, and it's certainly in a near-term uptrend. That's, doesn't take a rocket scientist to figure that one out. We're in a very strong near-term uptrend. There's the rally in gold, silver's doing well, and so where I'm going with this is it puts me in buy the dip mode. So this pullback today, you come down to a 60-minute chart, or even let's look at a 1-minute chart and just show you what they did. They faded that rally in gold, just like the stock market. They faded the drop, and here's the gap. And again, if you're looking for a perfect gap fill in an environment like this, this is why I always say step in early. And it's the same reason on price targets. I gave you the targets on QQQ and IWM I've had for a long time. You want to be safe, you cover a little bit early, or you lower your stops when you get to them, because when everybody sees the same thing, a lot of people missed the boat on gold. Now they want to get in. They didn't want to get in a few weeks back if I pointed out a divergent low or anything else. Maybe they didn't see the triangle breakout, but it's just human nature, especially those that don't know technically. They see this and now they want to buy gold. Now all of a sudden, after all these years, the last couple years, it just sickened me that people had written off gold as a flight to safety asset. Well, it's been that way, for as long as the financial markets have been in their modern form, and all of a sudden everybody was writing it off, or a lot of people were saying, "Oh, cryptos replace that. Now cryptos are the new gold." And I said no, and I said even if you want to say that silver and gold are now no longer flight to safety assets as they've been often in the past, I made the case simply on a fundamental. You see aluminum, copper, palladium, platinum, all shooting up, and people seem to forget. So strip out any flight to safety aspect. You have the precious metals are also very much industrial metals. Gold is one of the primary conductors for electricity. As silver, these things are used in many industrial applications, and so I think the market kind of forgot that about them, and that's one reason I've been bullish from a fundamental perspective, because they have some catching up to do to the other metals. We're in a hyper inflationary environment, not an inflationary environment. The rate of inflation now, they're saying it's matching what we had over 40 years ago, which was the worst inflationary environment in a long time, at least in my lifetime. But the difference now is the rate that this has started far exceeds that back then. In the 70s, it was ticking up, peaked in the early 80s, but it was a gradual move. This is an explosive move up, and the trend has showed no signs of slowing, and therefore, again, I've been bullish on commodities, and gold and silver are a commodity, and I think, again, the markets kind of forgot about that. So enough rambling there. The bottom line is, it's, with the recent buy signals, I think it's, buy the dip mode. So you buy the dip back to support. And today, coming close to that gap, you might want to wait for the gap. Why wait for the exact backfill and risk missing out on a nice entry, just like we're shorting the stock market today, for another point? It says that's 0.2 of 1%. So again, there was a buy the dip op, and who knows? Hey, we fall more, buy more. I'll buy more until and unless that breakout fails. And the breakout to fail means you need a weekly close, solid close back below the downtrend line, below the triangle, and you still have support. That could even happen. So it's going to take a lot for me to pivot on my the bullish stance I've had on gold for a while. There's a long-term trend line as well coming in right there. But anyways, I just wanted to share those thoughts, and so nothing's changed. Stock market is a sell the rips, kind of cover the dips, cover if and when you want to cover and you hit support, because we're in a downtrend, and gold being in a near-term bull trend and potentially much longer term, still in a longer term bull market, it's a buy the dip mode. All right, and silver probably the same thing. Let's look at that real quick for you. There's the breakout in silver or downtrend line, positive divergence right here. Well, really from right here, that's your divergence line right there. And there's your breakout candle, and still intact. And you have a little, pretty much that, yeah, right at, I had a line here. I could have probably, and certainly will, and we'll add it now. I know it's a little bit of hindsight, but we came up and hit the top of that candle. And so it's minor resistance, but I think we'll still power on up. I'm going to take that line away. I just wanted to mention that's what checked the rally in silver today. And again, buy the dips. At least that's the mode I'm in right now. And then last but not least, Treasury bonds. Remember, Treasury bonds, I remain, bonds in general, longer term bearish on bonds. We're coming off a zero rate, a floor in interest rates. It really couldn't go any lower. Fed made it clear, and I agree, it would be a big mistake to go to a negative interest rate policy in the U.S. So pretty much going forward, interest rates have nowhere to go but up. And they can stay low, so it puts the worst in the history of, again, at least in my lifetime, and I don't know if we've been here in the financial markets, but we've never seen a much more abysmal outlook, which kind of plays into a longer term outlook for the market. It destroys the old rule of asset allocation, where investors, based on, the rough number was you take 100 minus your age, and that's the amount should be in equities. So someone that was 20 years old should have maybe 20% of their money into fixed income bonds and 80% into stocks. I can't draw with this. It's a line tool, not a drawing tool. But and then, the old theory is the older you get, more into bonds, less into stocks as you approach retirement. So if a big correction comes, you don't get wiped out. Well, guess what? And that's always worked great in the past because bonds and stocks have had an inverse correlation. When the stock market corrected or in a bear market, bonds usually went up and vice versa. And so it balanced, smoothed out the bumps. Well, the outlook for the bond market, again, at best, even if bonds don't go down, even if rates stay relatively where they are at the floor, then you have virtually no upside. There's no upside appreciation of the bond principal, because of the fact we're near zero and can't go any lower. And so you only have downside potential for the value of bonds. In the best case scenario, if we stay down here for a long, long time, Powell keeps rates near zero, and long-term rates also hover very low, then you're collecting interest. You might not lose any principal on the bonds, but you're going to have a paltry interest rate of anywhere from less than 1% to not much over. And then you have, of course, the whole other thing. And there's that, anyways, there's that divergent low. And the only other thing I'd note here, a little small divergent high in treasuries, and there's that coincides, if you can see it here, with the rally in the stock market since this morning. Remember, bonds are a flight to safety asset, very much so. They've always been the king of flight to safety assets. Big institutions will flock to them in times of market volatility. And so today, you can see ZB hit my 154.88 target right there with negative divergence, and it's had a little pullback. But longer term, I think in the near term, and again, I'm not using these as long-term investments anymore, just tactical hit and run kind of trades, long, short. I don't want to get married to any bond trades for any long period of time. But you can see TLT has broken out above this trend line, and it's really back testing right now. So it's been moving up. It hit major support right here at about 134.70. You can see that was great support back here. I've covered this recently and highlighted these as a trade idea, and they've been moving up in conjunction with weakness in the stock market. So there may be some more upside there. TLT, that's what it's, I don't have the 60-minute marked up. We had some divergence here recently, and I don't want to spend too much time on TLT, but I wanted to cover some of the other bonds for you real quick, show you what's going on with corporates. See, this is reflective of the economy here. LQD are the investment grade corporate bonds, and that is a good proxy. A lot of bonds bore stock traders. They don't want to trade bonds, Randy. They move up and down in fractions of a percent a day. Not a lot of juice in them. Well, they are a tell to the overall health of the economy. The smart money, institutions, professionals are trading the bond market. And when you start to see corporate bonds fall more so than treasuries, and especially these are in the investment grade, very much so, and then junk bonds as well. Junk bonds have been dropping. This means credit spreads are going up. The difference paid between safe haven treasury bonds and these low quality below investment grade corporate bonds. And so far that's a red flag to the economy and the stock market as well. And and then finally, just kind of wrap up my whole doom and gloom thing. If that's what's going to happen, with much more downside to come over the next well, both several days, weeks, but even more so going out this year and possibly beyond, is what's happening here with the stock market and the bond market falling, because of the rates going up. Remember, this is treasuries right here. Overall, the trend has been going down. This is breaking the old tried and true asset allocation model, that institutions for many years, individuals as well, but the professional institutions most certainly. Individuals tend to take a lot of risk, pile into all stocks or bonds sometimes. Pension funds, which are severely underfunded and have been for years in this country, will have a diversified portfolio. They might be overweighted or underweighted in equities at any one point, but they have historically counted on their bonds and safe haven investments to offset losses. But you can see here, bonds have been falling. Especially, let's just focus on what's happened recently. Okay, this is Treasury bonds peaked back in on December 3rd, right? Corporate bonds have fallen off a cliff since that time right there. Okay, so they're losing on their bond holdings. There's not a single bond class or subset. Junk bonds, municipal bonds, MUB, they're all falling, right? So they're losing there, and we know what's going on in the stock market around that same time as well. This is January. S&P topped on January 4th, but everything else and what they're loaded, chock full of, Facebook, Amazon, Apple, Microsoft, that all topped back in November, and so everything's falling, and so that's just not a good sign for the overall health of the economy and the financial markets, really. So we'll watch and see what happens. It's not too late if this can get up here and we can have a nice rally and go on and, like I said, take out this trend line. It's just the longer we stay down here and the more this happens, and the less an offset that the institutions get from bonds, in other words, their bond holdings or whatever else they have, real estate, it's all, that's where a lot of pension funds and et cetera have moved into in recent years. They started loading up on real estate. They're going with private equity and other firms and companies that buy REITs and buy houses and they turn around and rent. It's all falling. So there's really nowhere right now. Crypto's falling, and a lot of them have also dabbled and got their feet wet with Bitcoin and all that other stuff, and that's all falling. So it doesn't look good. It doesn't look good at all. And remember, things can break when those. I'll leave it at this. If and when those pension funds out there, and there's massive amounts of money there, when they hit those threshold, they have to. I talked about this earlier, that delta hedging works great in a bull market when things are going up, when Apple and Amazon are all going up, the NASDAQ 100 and S&P 500, you can buy put protection on the cheap because the VIX is low, volatility is low, premium on those puts. So delta hedging is if you own, QQQ, you're long QQQ, you buy puts on it that will protect or minimize or cut your losses at some point where those puts kick in. And again, that's what keeps a lot of these funds going, allows them to leverage up, take pretty good sized positions and minimize their risk. But however, so they were delta hedged and that helped them here. But guess what? Those puts, like all, have expiration dates and they have to roll them. And as this starts to happen, the premiums on those puts begin to swell. So it's no longer cost effective. It becomes less and less cost effective the higher volatility spikes and the more you come down. At that point, when they're no longer hedged, then they have to dump their positions. They have to reduce their risk. in the market, and that means sell. And that's where you get those waterfall type sell-offs that I keep talking about. And so far, looking good. And we have a green candle right now, and this is what I'll be watching. I'm going to leave it here. Let's see how we close the day. So far, and give the bulls some points. They came in, they popped that gap. I suspect it'll fade. And again, it's one day, and if it does, that's going to be a knife through the heart of the dip buyers. If they can't hold most or all of these gains and then build on them going forward, if we undercut today's lows, you're looking at a big red candle, I would believe, bigger than that. Quick move down to my second target, and I wouldn't be surprised if we even saw circuit breakers kick in the next week or so, if that happens. So let's just watch today and keep it simple. If we fade all of today's pop and head towards, even get close to those lows, I think that's where the bottom will fall out. Just a guess. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.